after we do opening remarks, I can start sharing the screen. And okay, do you think we should start letting folks in? Everyone good to go?
Yeah, 9:56, sure.
Do you want me to stop sharing the screen?
We can share for another couple minutes while people enter. I think that's fine. Thank you, Emily. Everyone that's joining us, thank you so much. We're going to get started in a few minutes.
I just learned something new sitting here. I had to put my phone on Do Not Disturb while we're on this. This is great. Guys are teaching me something today.
Thanks everyone that's joining us. We're going to get started in a few moments. Welcome everybody. We're just going to wait a few more minutes and then we'll get started. Welcome, everyone. We're just going to give it a couple more minutes. Great, we'll just get started another probably 2 minutes. Great, I'm sure more folks will join us as we go on. Emily, if you want to stop sharing and we'll move on to introductions. Great. We have more folks joining, which is wonderful. We're already up to 32 this morning, so gonna give it to Jeannie to welcome everybody.
Hey, thank you, Melissa, and welcome everyone. It's a little bit cold out there this morning, but I want to wish you all a warm welcome to all the participants today for participating in our virtual financial literacy workshop for first-time home buyers. And I especially want to thank Rhinebeck Bank for sponsoring our workshop today. And I would like to thank Vincent, and I hope I don't mess up your name, Aurigemma.
Very good.
Okay.
Very good on the first try.
And also LaShonda Denson, who will be hosting us today. Vince is the Vice President, Residential Mortgage Lending at Rhinebeck Bank. And he's presenting, like I said, with LaShonda Denson, who is the Home Ownership Center Manager from Hudson River Housing. And I would also be remiss if I didn't thank and acknowledge my wonderful team members, Melissa Clark, Yadira Sims, and Emily Darrow for making this workshop possible. And I tell you, I wish I had gone to one of these before. I've only bought one home, but I wish I had gone to one of these before I bought a home. But we want this to be interactive, so please feel free to use the chat box, with any comments or questions or concerns. And we'll try to address them during this workshop. And without further ado, I am going to turn it over to LaShonda.
Hi, good morning, everyone. My name is LaShonda Denson. I am Hudson River Housing's Homeownership Center Manager. I've been with the agency for 20 plus years. but I've been with the Homeownership Center since 2007. We offer everything a first-time home buyer needs to shop for, educate themselves, counseling. Our counselors are there to walk you every step of the way. It's a daunting process, and it always helps to have that extra person who's can lend some sage advice on how to be a successful homeowner. Currently, we offer homebuyer education through Zoom and online. Our homebuyer education consists of a total of 9 hours of education, which can be done over a period of months or a couple of hours, depending on the person's situation and their preference. And we also offer services beyond being a first-time home buyer, such as financial fitness. We also offer foreclosure intervention for those homeowners who are struggling to make ends meet with their mortgage. So that is in a nutshell of all of our services that we do at the Homeownership Center. If you're ever curious, stop by, call us up, and we'll be able to help you. And from here, I give it over to Yadira.
Good morning, everybody. My name is Yadira Sims. Feel free to call me Yaya. I actually prefer Yaya, by the way. And I get the honor and the pleasure to introduce our speaker for the hour. But before I turn it over to him, I'm going to read his bio so we get a little background information on Vince. Vincent Aurigemma has over 30 years of experience in sales management, with the most recent 19 years spent in the mortgage industry. Vincent is an affiliate member of the Dutchess County Association of Realtors, the Ulster County Board of Realtors, and he currently serves as the president of the Mid-Hudson Valley Mortgage Bankers Association. He enjoys spending time with his wife of 27 years, Maureen, and their 3 children. Vincent has been a high school boys basketball official for the past 17 years and served as a past president of the International Association of Approved Basketball Officials, Mid-Hudson Valley Board, number 114. Vincent knows the Hudson Valley region and all of its nuance of its mortgage industry. Being part of a secure local community lender is what makes him want to be part of Rhinebeck Bank. All right, that's our background on Vincent. Now I'm gonna turn it over to Vincent.
Good morning. And the first thing I'm gonna say is I'm very jealous of Yaya because I love that nickname. I told her that yesterday. I won't share my nickname growing up, but it wasn't as fun as Yaya. So, Yadira, thanks so much. Thank you, LaShawn, and all, and most of all, thank you all for being on this call this morning. I really hope and I believe it'll be time well spent. Some ground rules first. Do not wait till the end for questions. If you have questions as we go through, please pop them into the chat box. Melissa's going to be monitoring that for us, and we could bring them up. If for some reason I'm going to, get to your question in the next slide, I'll address it and go there. But otherwise, we'll answer them as they come. So please don't be shy. Bring those questions up. The good news is there's no test at the end. So let's roll right through it. So here we go. And we can move on to the welcome page. You literally, like millions of others, you really dreaming of owning a home. You may have been considering this for years, only recently have begun to think it over. In either case, you need the right information to help you decide when you're truly ready to be a homeowner. And a full understanding and knowledge of the process can help you make the right decisions. Melissa, you can go to the next slide real quick. Decisions which could potentially save you thousands of hard-earned dollars in interest rates and fees. So we're going to talk about the important steps in qualifying. We're going to identify the key players involved in the whole process and help you understand some of the variety of loan programs geared to help the first-time home buyer. So some things we're going to sit on and go a little bit in depth, but we're really going to touch on the process so that you have a real firm idea of what you're in for and what to expect as you're buying a home. So let's begin. So next slide, decision to buy. Okay. So we've got some advantages. You're building equity. Okay. So it's really time in the market, not timing the market. And what we mean by that, that's an old saying, is that everybody wants to buy at the low end. Oh, prices are the lowest, I'll buy and I'll gain equity. Well, that doesn't always happen. Over time, as you're paying your mortgage, the market's going to fluctuate up and down. You're going to, prices will be up, prices will be down. It really depends on how long you own your home. Every month you make a payment, you're paying principal on that. So you're gaining equity as you go. So it's really the time that you have in the market. The other advantage, it's yours. You do what you want with it. You could paint it pink. I know this from experience because when my wife and I bought our first house, my oldest daughter wanted to paint her bedroom, and she was very excited about it. And I came home one day and I opened a can of paint, and it looked like a gallon of Pepto-Bismol. If you've ever seen Pepto-Bismol, it's pink. So that was her room until we sold the house. I didn't think it went with the brown rug, but she didn't seem to care. So you can do whatever you want with your home, which is great. It may offer you tax advantages. With changing tax plans, sometimes these things change, but obviously you always want to check with your accountant or your tax advisor, whoever's doing your taxes, on the advantages of writing off mortgage interest and your city town taxes. So there are tax advantages to do it. And obviously building roots, becoming part of the community, knowing your neighbors, really building some roots. If you have children, getting them involved in schools and setting up a foundation for them. So some items to consider. You have maintenance costs. When you rent, a lot of times you don't have that maintenance cost. When I bought my second house, we sold the first one. I thought I had everything I need. I lived in a house for 10 years, and we bought another house and sold the one we were in. And I still went to Home Depot every weekend for the next, 6 weekends, even though I thought I had every tool I needed under the sun. So there's always things to consider. Closing costs and down payment. Okay, it's more than just your first month and security deposit when you're renting. How do you account for those? And lastly, it's if you have to move, it's not that easy. If you're renting, you give notice and you can find another place. If you're owning, not so much. So just things to consider when you're looking to buy. All right, moving on. Speaking of language, so these are some things you're going to hear from many people in the process, whether it's a mortgage person, mostly from mortgage people, insurance people, whatnot. But first thing is PITI, principal, interest, taxes, and insurance. This is basically your mortgage payment. Okay, DTI is debt to income. We have two different sets of debt to income. We have a front end versus a back end. A front end is basically your PITI versus your income. A back end is your principal, interest, tax, and insurance. And then we add in all the other debt that you have that shows up on your credit report. Okay, and we'll talk more about that, what's on the credit report and the things that we have to build into a debt to income, back end debt to income. And there's different limits to these. On the front end, there's different percentages. When you look at your gross income, most lenders will, you can go up to 38 to 40% of that gross number on your front end principal, interest, tax, and insurance. And then you go a little higher on the back end, 45 to 48%, basically meaning the banks understand that they're going to give you a percentage of your gross income, because let's just say you have 40% of your gross income goes to everything: principal, interest, tax, and insurance, and a car loan, and some credit card bills. The lenders understand, and the agencies understand, that the other 60% of your income is going towards paying your payroll taxes, your phone bill, things of that nature. So that's why they set percentages of gross income. Okay. PMI, private mortgage insurance. What this does is this allows you to finance more than 80% of the home. Generally, when you're looking to buy a home, you'll hear a lot of stories of putting 20% down. You don't have to. You can, in some programs, finance up to 100% of the house. Most of the first-time homebuyer programs are 3.5% or 3% down. So private mortgage insurance is something that protects the lenders and allows them to finance more than 80%. Many, many loans that we do have PMI insurance on them. Okay. Escrows. As a first-time homebuyer, you're going to have to escrow for at least your monthly property taxes. Homeowners insurance, I always think you should, but some lenders will allow you to just pay it out on your own. Okay, it's basically just 1/12 of your yearly school and property taxes that are collected, and then at the end of when they're due, the lender pays them for you. Okay, you're going to hear about gross income. And this is what we use for qualification. We don't worry about your net, what the take-home is. We look at gross income, so the amount you earn before taxes or payroll deductions are taken. And then you may hear about points. Okay, points. Hey, I want to pay a point and get a lower rate. True points, okay, are really prepaid interest. So there's a difference between points and a fee. So what happens is, a true point, because it's prepaid interest, the bank will allow you to take a slightly lower rate because you're paying upfront part of the interest over the life of the loan. So they'll get a credit for that. I know it's tough to talk about this, really kind of get this concept over the phone a lot of times. It's easier in person, but again, we'll do some Q&A after this, and maybe that's one you want to sit on a little bit. But all right, speaking of language continued. A couple things. Pre-qualification. Difference between pre-qualification is not a pre-approval. Excuse me. It basically gives you an estimate on what you could possibly borrow from a home. A pre-qualification is really a conversation. Hey, how much do you make? How do you think your credit is? Give me an idea of how much you have in the bank. That's kind of the idea of that. A pre-approval is really a full review of your credit and your income profile. That's really what you want, because until someone pulls your credit and sees what your liabilities are, what your credit score is, everything else is just conjecture. So if you're ready for real pre-approval, either sit with someone or have a phone consultation where someone is reviewing your credit, which is really good because you may see things on there that you didn't know were there. Things are easy to get on credit. We'll talk about this a little later. Sometimes harder to get off. Okay, credit bureaus. So credit bureau is an agency that collects your payment data and history on all your loans, revolving debt, public record information. There's 3 of them. There's Equifax, Experian, and TransUnion. And lenders use a combination of the 3. Use all 3, and we take the middle score for what we use on qualification purposes. Okay, annual percentage rate, APR. This really shows the cost of your mortgage as a yearly rate. Okay, this is really difficult to explain over the phone. The thing you want to look at with APR, because this will include your upfront fees and interest, the APR is going to give you an insight into comparing loan costs between lenders. So let's just use some round numbers. If you looked online and one lender said, hey, our base rate is 4% today for a 30-year fixed, and another lender said, hey, our base rate is also 4% for a 30-year fixed, but the APR for one of them was 4.25 and the other was 4.5, you would be able to know that in that 4.5 APR, there were some fees that were buried there that you'd have to look for on a good faith estimate or a loan estimate, if you will. So it's a way to calculate the cost of how much that mortgage is costing you. Okay? So closing costs. Closing costs are one-time costs included in obtaining a mortgage. So title fees, county mortgage tax, appraisal fee, those type of fees that are just one time associated with the transaction. Prepaid items are ongoing costs of home ownership. Okay, your taxes, your insurance, that's actually the T&I of the PITI, the taxes and insurance. So those items, when you go to close on a loan, you're going to have to take account of. So, your yearly taxes and your homeowner's insurance. Okay? All right. So let's get out of the language. We're going to talk about qualifying now. How do we qualify? What's it all about? So it's all about 3 items: income, assets, and credit. So income, how much do you make? Assets, how much do you have? And I mean how much you have, all of it. We're not trying to spend it, but we need to know all of what you have, because a lot of times we will show assets for reserve fees. The lending agencies like to see that you have reserve funds in case something goes wrong, you have an interruption of your income. Okay? Credit. Extremely important, because we need to know why it's great or why it's not so great. So explanations are very important, and credit is very dynamic. Credit changes all the time. As your balances change, every month you flip the calendar, your financial information is reported freshly to the credit bureaus, and that adjusts your score. That credit report is one giant mathematical problem that is constantly changing. Okay? So we're going to address these individually and move on to income.
Vincent.
Okay. Yes.
Before you move on, we have a question.
Yeah.
From Zekas. Sorry if I'm pronouncing it wrong. Once you get pre-approved, how long does that typically last before it expires?
Typically lasts as long as your credit report. So, generally 90 days, 90 to 120 days. But we do like to, we don't want to pull credit all the time. We generally wait until it expires to do that. But your pre-approval is generally good for at least 90 days. Because we know that, credit reporting agencies and the investors, Freddie Mac, Fannie Mae, who we underwrite per their guidelines, will accept loans with credit that is within 90 days. So, okay? Here we go. So income, documented ability to repay. What does that include? Could include your federal tax returns. We don't use state tax returns. We use all federal tax returns. So either your last year, or it could be up to 3 years of federal returns. Could be personal, just personal returns, or if you have a business returns. Okay, your employment history. So generally we need at least the last 2 years. We need to explain any gaps, any changes, any increases or responsibilities in your pay. Anything that's changed, we just, we like to get a verbal account of why it's changed, and most times for the better. People have gotten new positions, gotten raises, work more overtime. So we really carve through a lot of that. So current pay stubs that include your year-to-date income, okay? Because we do need to know about overtime if you have it. Is it seasonally or seasonal? Excuse me. We take all of that into account. There's ways that we can look back at previous years to judge and get an idea of what, if you work in an industry where your overtime comes mostly at the end of the year and you're looking for a loan in June and you haven't gained that overtime yet, there's a way to look back and say, okay, well, we generally, we can do a verification of employment and kind of judge and give you credit for some of that overtime you haven't earned yet, but we know that it's coming. So a lot of detail goes into this. And then any other documented income sources or payments. a child support, alimony, Social Security, disability. You know, some of the programs are based on household income or total income. So we have to know the full scope of your income profile for the household. And then there's other times where we can use a non-occupant co-borrower. So like a co-signer, mom, dad, aunt, uncle, grandma, grandpa, whatever, we've seen it all, who will co-sign and be a co-borrower on the loan. They're just not living in the home. There's guidelines around it, but to be honest with you, we do this fairly often. So that is a possibility. Okay. Any questions on income? If not, we'll move to assets.
Yeah, I'm just going to quickly take a look at the chat box and see if there's any
Please.
others. Mhm. Great. It looks like we're good. Thanks so much. We'll keep
All right.
moving.
Perfect. So we're going to move on to assets. Okay, funds needed for down payment, closing costs, and prepaid items. So, of course, obviously, you know, any checking and savings, if you have any investment accounts, any CDs, gift funds. Believe it or not, you can get, I mean, if someone is not going to be a co-borrower but would rather or can give you gift funds, you can get a gift from, you know, a family or a relative. There we go. We would simply get we'd provide you with a gift letter to give that person. We would verify the assets coming in. And they're very, very, very common in the mortgage process for folks getting gifts. Seller's concession. When you're negotiating your price for a house, the seller can actually give you a concession to go towards your settlement costs. So let's just talk about this real quick. That's how a seller concession works. I'm going to use, you know, again, just kind of base numbers. Let's just say that somebody has a house listed for $110,000. You really want, you know, to give them, you know, you really want to pay $100,000 for the house, but you say, you know what we'll do is we'll split it. So we're going to give you, you know, we're going to give you 110, okay, but or we're going to offer 110, but at closing, you're going to give us $5,000 back towards our settlement cost. So basically, we finance based off of $110,000 purchase price. The seller will net from their sale $105, and $5,000 then just gets, it's basically transferred from one side of the closing statement to the other. It basically then becomes a credit to you at closing for $5,000. Okay, so there's ways to negotiate in a seller's concession to help you, and that can go towards, seller's concession can go towards closing costs and prepaid items. Can't do it for any, you know, down payment, but it can offset your taxes needed, your escrow, any of the cost to close. Okay, so, and again, that's extremely common in this business in setting up, and most realtors are very well adept at setting up offers with seller's concession. Okay, First Home Club. And actually, this is now the Home Buyer Dream Program. So I think this is one slide I didn't change. The Federal Home Loan Bank of New York, and this is something that LaShonda can help with. Federal Home Loan Bank of New York has a Home Buyer Dream Program that is basically a $14,000 grant, forgivable, that you can use towards down payment and closing costs. So we may be talking about this later on in the slide. I think I changed it later on in the presentation. I may have missed this slide on that one. There's Sunny Mae DPAL, down payment assistance. Sunny Mae is a state of New York mortgage agency. It's a bond loan. They allow 3% down, but they will give you that 3% in a forgivable loan So in essence, it's 100% financing. Okay. And then part of Sunny May, they have an NRP grant fund available. So Neighborhood Revitalization Program through Sunny May. That's $20,000, which can go through for any repairs that are needed on the property, as long as the property is vacant. And again, you see that little asterisk there. Hudson River Housing can really help on these. They're very, very good at them. Have a lot of information, so don't hesitate to reach out to LaShawn on that, because they're just terrific programs. And again, they're liens per se, but they're forgivable over time. So you can't buy the house and take the funds, and then a year from now, sell it, make a profit, and not pay them back. But as long as you're in the house for, I believe it's between 5 to 10 years, they're forgivable, and great ways to come up with assets you need for a transaction. Okay. Oh, and actually the next slide, let's flip to that. Melissa.
And I'm just we have a couple of questions, Vince.
Oh yeah, sure. Let's
Sure.
go.
So when is it worthwhile to refinance? What interest percent savings? 1%, 2%?
It's a great question. The old adage is, if the rate doesn't change by 2%, it's not worth it. Well, that was applicable when you bought a house that my parents bought that was, $50,000. At $50,000, just in the relation of numbers and percentages, in order to really affect your monthly payment, yeah, your interest rate would have to change by about 2% to really make it worth it for you on a monthly basis. But depending upon your loan amount, so if your balance is $250,000, $300,000, $0.75 of a point to a point may be enough. And it all depends on what you believe is enough too every month. Whether is $200 difference in payment enough for you to refinance, or do you not want to do it unless it's $350? So that's a roundabout way of answering the question and saying there really isn't a rule of thumb. It all depends upon your loan balance and really what your tolerance is of monthly change in order to make it worth your while.
Great, thank you so much. And we have another one, actually another couple. This is great. Everyone, please keep them coming.
Great.
Yeah, so the next one, sorry, it's just up above, is if the person doesn't have assets, what happens?
Well, again, there's a couple different ways around it, but you have to have some assets. Like even with Sunny May, you've got to show at least, I believe it's 1% that you have, saved. So you need to show some type of ability to save. And remember, the reason being as well is that an underwriter is going to look at this and say, well, if you're going to take your payment from renting at, say $1,000 or $1,200 to a mortgage payment of $1,500, and you have not been able to save now, how are we putting you in a situation where you're not going to be able to maintain what how you're currently living now? So we need to show that there's an ability. You have to save a lot, and it may be that you're actually paying down certain debt. But if we can show on our debt to income ratios that you have the ability then to save, we can find ways to bridge the gap. One way, like I said, is Sunny May, where you're actually taking the down payment assistance and they're giving you the 3%. You do have to show some, funds. So listen, if you literally have no savings or no assets, we need to have a conversation about how you get to the point where you have enough just, to start.
Great, and sorry, we just have a couple more, which is great.
Sure.
Keep them coming. This is why we're having this workshop today. So thank you so much. We have a question: where can we find listings for homes in the city of Newburgh that accept NRP grant, First Home Club, and DPAL?
For the NRP grant, all they have to be is vacant. So there's really no special characteristic to them. And Sunny May, whether the Sunny May DPAL is not is not dependent upon any type of house or condition. It's you know, and you know, Sunny Mae also has a remodel program, so you can do a renovation loan, and again, we'll talk about that a little later as well. So you can take something that needs repair, and it's a process, but you know, to do those type of loans, but you can actually take a house that needs repair and plan on all the work to be done in the loan, plus using DPAL and NRP funds. So we've got some loans that are just like that. They're remodel loans. So someone is actually planning on renovation happening in the house. They're getting NRP grant funds to account for some of that, and they're borrowing the down payment up front. So there's a lot of ways to do this. You know, the key then is finding that right property. There really is. I mean, all I can tell you is Realtor.com, Zillow, those type of, or you know, find a realtor that you know, connect with and you want to work with, and have them look for some listings for you.
Great, great. And I know we need to keep going, but we have just a quick question. What is the cost of refinancing? And then I have one more after, and then we'll keep moving.
Sure. Cost of refinancing, there's really no, I mean, I don't like to give out percentages, hey, 2 to 3%, whatever, of your mortgage, right? You're going to have to do a new title policy, which is a reduced title policy. You may or may not need to do an appraisal. Some of the systems now are giving us some appraisal waivers. If you stay with your current lender, I can tell you that generally they can do what's called a CEMA, a consolidation, extension, modification agreement, which allows you to not have to repay your county mortgage tax. So I would always check with your current loan servicer first, whoever is sending you your bills, whoever your loan is with, check with them for a refinance first, because generally they should be able to do what's called a CEMA in New York. In Dutchess County, I could tell you, just on, you know, if your mortgage is $200,000, your mortgage tax is roughly $1,600. So staying with your current lender could save you right off the bat that. Okay. And on that, I'm sorry to be vague on the cost, but it's kind of hard to nail down, because some of this is going to be dependent upon, you know, how much your mortgage amount is, because some of these, a lot of the costs are a percentage of your loan amount.
Great, thanks. And can you negotiate on homes that have been on the market for a while?
You can negotiate on anything. And I would encourage you to do it. Now, you know, let's be honest. This is a very crazy time in the mortgage business. As it was said in the beginning, I've been in this business nearly, you know, for almost 20 years now. This is by far the busiest I've ever seen it. And we live in an area that we are under the comfort and the blanket of New York City. We're kind of the farthest suburb, if you will. So what's happening right now is we have pretty much the lowest rates in the history of rates. So interest rates are extremely low. So the refinance market is incredibly busy. But we also have a pandemic and a flight of fear from New York City, which has, for lack of a better term, kind of made the purchase market go insane up here. So, you know, prices have risen. The good news is it's given people who own a house equity in their home. So people who wanted to sell and maybe didn't have enough equity have been able to now put their home on the market. The bad news is that, you know, prices have gone up. So in that time, it will compress and squeeze your borrowing power on what you can find. And it's not like we've had an overabundance of home listings for the past 3 to 4 years anyway. We have been on the decline as far as homes on the market. We've needed inventory for years. And this has kind of leveled it a little bit, because we've got more people putting their houses on the market because of the increase in equity. But we also have houses that are getting snapped up really quick for above asking price. It's a very hot market now due to market conditions. So again, to go back to the original question, negotiate. If and tell a story. Make sure your realtor kind of paints the picture of who you are and why you really want the house. That does go a long way with sellers at times. But yeah, always negotiate. Whether it's been on the market for a long time or whether it's been on it for a week. You're right. If the listing's been on for a long time, there's a reason why it's been on for a long time. Maybe overpriced, maybe people a little unrealistic in their expectations. But yeah, that does give you a little more, I think, bargaining chip in negotiating. So.
Perfect, thanks. We'll keep going and then we'll do another pause later on for more questions. So keep them coming in the meantime in the chat box. Thanks so much, Vince.
Great.
It's really enlightening.
Perfect. All right, we'll flip. Credit. Okay, here we go. So credit scores can have effect on fees. Okay, so the higher your credit, generally the less risky. Let's just talk real quick about, this is kind of a banking 101, okay? Risk equals fee. So lenders and the investors, the agencies, Freddie Mac, Fannie Mae, the greater the risk of a loan, they're going to offset that with some type of pricing adjustment or a fee, because it's a riskier loan that and their numbers have shown that it might have a propensity to underperform. So the farther you get away from more money down, really strong credit, owner-occupied property, when you get into investment properties, lower credit, higher loan to value, those are when they're going to offset that with a fee. So higher credit scores, have a positive effect on fees, and that they will be less. Okay. So checking your credit report for accuracy, accurate personal information, accurate account history, credit inquiries, public record information. Let's put it this way. There's things that, and we see it happen all the time. Somebody has their credit pulled, and they're like, wow, I didn't know I had a $50, collection account. Well, a collection agency buys, okay, how they work. They buy old receivables for pennies on the dollar. They're not going to spend any more money to try to track you down for $50. They're going to attach it. They're going to put a collection out in your credit report, and they're going to allow you to find them when someone pulls your credit and says, oh, wait a minute, what's this about? So a lot of times we see things that are on people's credit report they don't even really know about. Now, they're supposed to reach out to you and let you know. There's laws around that, and we believe they're trying to do it. But there are times where there's surprises on credit and people didn't realize there's certain things on there. So it's a good exercise if you're looking at to buy, to get that credit pulled so that you know exactly what you're working with. Okay. So factors that are considered in your credit score: payment history, track record. The big time frames are the last 12 months and the last 24 months. Last 12 months, we'll see credit jump as soon as you click on an account that you've gone from 11 months to 12 months of on-time payments. Scores will rise. The same with 24, with 2 years of payment history, because it's really a credit report is literally just a predictor of how you will pay your bills. That's really all it is. Amount owed versus your account limits. Okay, you always want to try to keep as best you can. Well, that's coming up later. So if you have a limit on a credit card of $2,000 and your balance on that is $1,500, well, your score is going to be a little lower than someone who has the same credit card of $2,000, but their balance is $300. Okay. They want you to have credit established, but they don't want you to use all of it, okay? And then length of credit history, new and existing. Once you get a new, a new credit card, something new on your credit report, you're going to take a little ding. It's going to come down because the credit report then doesn't have 12 months of history on that account. It doesn't really know how you're going to pay it. And then every month that you're paying it positively, you're going to improve a little bit more and a little bit more and a little bit more. Okay? So let's talk about managing your credit. The next slide will be about managing credit. So obviously, number one, pay what you owe to the best you can. Okay, responsibility of debt. You want to make sure that you're responsible for your debt. Very critical to pay attention to the due dates, because you'll have a liability that's due on the 1st of the month. Okay, you may not pay till the 10th, till the 15th. You may not pay till the 28th. That doesn't hurt you. Now, you may pay a late fee, which you don't want to do, but you're not considered late until you're 30 days past the due date. Okay? It's only when you go over the due date by 30 days that you're going to get dinged on your credit report. That's kind of why it's your credit takes a hit on those 30-day lates, because they've actually given you a 30-day cushion to pay it. Okay, so be aware of those due dates. Limit the number of your credit lines. Okay? Not that we walk in and out of stores anymore, but this was the big one about the 10% off the purchase with the new card. Yeah, well, no thanks. It's if you get a bunch of new store cards and your credit takes a dip and you're going to buy a house, it's going to be a lot more expensive than that 10% you saved at whatever retailer you decided to shop with. And plus, most of those come with an annual fee that offsets that 10% anyway. So, keeping new trade lines at a minimum. Again, every time you get a new trade line, it takes you about 12 months to, not to fully recoup, but you're going to get, you're going to take a hit on your credit score for having a new trade line, again, because there's no history there behind that to show how you're going to pay it until you get to 12 months. And here's what I was talking about before: maintaining low credit balances on revolving debt as much as you can. I mean, I know sometimes, listen, you have to use your credit card. There's things you need, there's things you have to pay for. Life happens, and we need to use it. But the rule of thumb is trying to keep it below 30, at or below 30%. So if you have a $1,000 card, trying to keep it at $300 or below. They want you to have some room so that if you have a income interruption, that you have the debt, you have the credit then to go to. If you're maxed out on cards and something happens to your income, what happens then? You have to get a new card. So they want you to have the ability to use that for any type of income interruption. Make sense? Okay. All right, here's where we're going to dive in the weeds a little bit with math. Again, no test at the end. So we're going to talk about exactly what it is that we look at. I want to give you a little insight into how we calculate a number and how we calculate how much house you can afford. I don't expect you to be able to do math after this. I just want you to know that when somebody's actually working with you on a calculation, what it is they're looking at to give you a sense of how we determine house price and affordability. So I'm just going to look at a scenario to determine what your maximum mortgage can be, okay? So we're going to take, in this case, we're just going to take your gross income. We're going to say, okay, you've made $54,000 a year. We're divided by 12, okay? I've got the wrong number there at 48, but the 45 is right, okay? I put 48,000 divided by 12, should be 54 divided by 12, but 4,500 a month would be 54,000 divided by 12. So 4,500 a month, remember, gross numbers, right? Gross numbers. And then we talked about back-end PITI, principal, interest, tax, and insurance, and the rest of what is on your credit report. So let's just say that we're going to cap this at 45%. So 4,500 times 0.45 is 2,025. That means that between your house, principal, interest, taxes, and insurance, and the other items that are on your credit report, car loan, credit card payments, student loans, whatever they may be, are not going to be more than $2,025 a month. So, next line, we're going to subtract out any of the monthly debts that are on credit. So let's just assume they're $425 a month from your credit report of what you have monthly liabilities. So your maximum then front-end ratio, just your PITI, principal, interest, tax, and insurance, can be $1,600. okay? That's a total amount of PITI you can afford. Now, just so you know, these numbers can change. That 45%, I've seen it approved at 50. I've also seen it not approved at 43. Depends on your credit. So again, this is just to give you an idea of how we are looking at your monthly payments and how, because we're going to back into a house price, okay? So this is where we start. Okay, $1,600 a month. Let's go to the next slide quickly. So then we go even further. And again, estimates only. How to determine the range of homes to look for. So we're going to separate that principal and interest from the taxes and insurance. So we know that monthly housing debt can be $1,600. Let's just say taxes are going to be $6,000 a year. So we're going to subtract out $500 a month. We're going to subtract out $75 a month for homeowners insurance. And if you're going to finance more than 80%, we're going to say, oh, you know what, your PMI is $90. So that leaves us with principal and interest of $935 a month. So that is, with that, we are going to determine how much house price you can afford. Now, I can't really show you that now because it depends on the interest rate. So you're going to, at $935 a month at 4% is going to be a different loan amount that you can afford than $935 a month at 3% or 6%. You know, at 3%, you're going to be able to afford a little more. At 6%, you'll be able to afford a little less. But that's how we work through your income to get to that little nugget of what we can use for principal and interest and how much mortgage can you afford. So once we know how much that $935 a month will afford in mortgage payment, we will then know, add in how much you have for down payment or assets available, and then you can start looking for prices in that range, okay? Any questions on that, Melissa? That's a lot. Listen, that's a lot to absorb. So I don't expect you to all of a sudden grab your W-2 from last year and start doing math and carving this up. But when someone's working with you and doing some of this, I want you to have an understanding of why it is they're looking at it and what it is they're looking for.
Great. Yeah, thanks, Vince. This is so helpful. I know I couldn't do this math without you explaining it to me. We do have a few questions.
Sure.
Are bank credit cards better than store credit cards?
Now, they report the same. So it's really, they're both, it really has to do with time and with balances. So they really report the same. They're both revolving credit. All revolving credit is treated the same. So one credit card is not any different than the other. The only thing, you know, we always ask you to look at is, hey, what's your interest rate? Is the store credit card higher? You know, and what are your balances? Generally, sometimes in a bank credit card, you can, you know, there are certain ways. If you have good credit, and let's just run this one real quick, not to belabor this one, but if you have, just say you have a $2,000 balance on a credit card and you've got a $500 limit, or excuse me, a $2,000 limit and a $500 balance, and you say, you know, I'd rather have maybe a lower ratio. You could always ask the bank to up your balance or up your limit to $3,000, which would automatically adjust your usage percentage lower. I wouldn't go crazy with that and try to boost it up, but there's ways to manipulate that number to get your usage amount is a lower amount, and by doing that would actually increase, you know, would actually give you a little boost to your credit score. So these are the things that and again, we're not credit counselors, but we'll talk about ideas and ways that you can help your situation. It's all about planning. You know, in some cases, buying a home is a sprint. In other cases, it's a marathon. I mean, I've worked with borrowers in the past for multiple years to prepare them to be ready to buy, and just happy to do it. So, go ahead, Melissa. What
Great. Yeah. Thanks. Do you anticipate the market will go back to where it was within a year, or will this most likely stay as it is for a while when we were talking about that crazy market?
This is a great question. Because the funny thing is I dare you to ask anybody to go back to last year and predict where we were right now. So my crystal ball is broken. So I'm not gonna predict. I will tell you what there's the experts in the field have said a couple things. So Fannie Mae, Freddie Mac, they predict that some predict that rates are going to stay 3 or below. Others are predicting they'll be at 3.5 by the end of next year. Here's what I can tell you: for the past 4 to 5 years, we've always been saying, well, this is the year rates are going to go back up to 6 and 5.5, and now they're the lowest they've ever been. So my point being is that I'm not telling you it's going to last all next year. A lot has to do, we're getting vaccine news. Does that, damper people coming up from New York City, or do people in New York City say, hey, even with the vaccine, I'm tired of going up the elevator one at a time to my 20th floor apartment. I need to get out in the country. So there's a lot of things to play into that. Personally, I could tell you I'm staffing at levels for this to continue. That's the best I can tell you.
Thanks. That's really helpful. We also have a question about what are your thoughts on rent-to-own homes?
Great question. Here's the trick with rent-to-own. People don't understand it. Rent-to-own is difficult, and here's why. Because when you rent-to-own, what a lender can give you as far as credit for your rent is anything that you pay that's above market value. So I'll use round numbers. If you're paying $1,000 a month in rent and your average market rent is $1,000, you really can't get any credit from your landlord for any of your rent, because you have not. They just can't arbitrarily give you equity in the property. So you'd have to say, hey, wait a minute, the average market rent is $1,000. I've been paying $1,200 a month, and therefore for the past year, 12 months or 24 months, I'm getting $200 a month in back in credit for the rent to own. It's really tricky to do it, and I could just tell you, and I'm sure there's people that have. I've been in this business 19 years. I've never seen one work.
Wow.
I'm not telling you not to do it. What I would tell you is, A, speak to your attorney about the lease and how that works, and talk to a lender to get the guidelines on how to structure that so that you can get credit for it. Because really, a landlord can't just arbitrarily say, hey, out of the past 2 years, I'll get $500 a month. It really has to be above and beyond what the average rent is to get the credit for that rent to own, as I understand it.
Great, thanks. I'll ask 2 more and then we'll keep going.
Sure.
How does it work with more than one person going in on the same house if they are not married, do not have a joint income? Are mortgage combined, or does just one person apply?
Well, it really depends on the scenario. We have many couples who are, partners, not married, don't have joint bank accounts. You can be borrower and borrower, borrower and co-borrower. You can still be on the same. It's basically the same loan. They're basically separate applications, but it's the same loan. Your information is just not co-joined, if you will, combined. So we would pull separate credit reports for each. If your assets or your income or your credit's not intertwined, or some are intertwined, and we then can do a joint application. So it really has no effect as far as buying a home. I can tell you that there are times where it's better if one of the, a spouse or a partner is left off of the mortgage. If someone's bringing debt but not income to the transaction, and it doesn't help, it's only a hindrance, you can still be an owner of the property. You can still be on title, but you don't have to be on the mortgage. So it works both ways, basically. You you can have separate lives, if you will, separate income, separate assets, separate credit, still be under the same loan and qualify for that same property, or one can be on and the other one cannot be on the mortgage, but can still retain ownership and be on title of the property. That make sense?
Yeah, I'll just say personally, when my husband and I were looking a few years ago, our mortgage officer ran it both ways for us, you know, how we would be able to qualify a larger loan if we did it together or separate. So thanks so much. And then just lastly,
we affectionately refer to that as a spouse-ectomy if we have to carve one of them out.
yeah, we had a spouse-ectomy. I'll just tell everyone. How can we estimate for ourselves what a prospective annual property tax would be?
Well, that's a great question. You know, really, you're going to have to get, and the first place I would go is to like a realtor.com, and I'd look in the individual towns. Because remember, school districts are going to play a big part in your annual taxes. So, you know, if you're in Arlington versus Poughkeepsie or Kingston versus, you know, Highland, or, you know, the school district is going to play a role in your tax base. So I would look at some properties in different towns and different school districts, and then get an idea of how much, you know, the purchase price of that property, type of property, and then just kind of look at a range of taxes there. It's really, I'm not sure if there's anywhere really to go online to look at tax information. We do a lot of this as far as, you know, looking online in Dutchess County, Ulster County for you know, property ownership and those type of things. I don't know if we really do it off of it, and that's not something that I could. It's not easy to do this one on this type of presentation to take you through how to find that online, the tax base. There's a way to do it, but it's a little clunky. But just as someone who's interested in property, look at some places that interest you online in different school districts, and you'll get an idea of the tax amounts per year from that. I think that's the first place to start, to give you a little comfort level or an idea of what you'd be looking for on a yearly basis, depending on the different styles of house and price.
Great, thanks. And we'll keep going, but we will ask more questions a little bit later. But this is all so great. And thank you all for your questions. These are excellent, and keep them coming.
Fantastic questions, really right on the mark. All right, we're going to jump into loan programs. So a lot of what we talk about, and I've mentioned Freddie Mac and Fannie Mae before, that's conventional mortgage financing. They both have 97% financing programs, so they both have a 3% down payment program. In many instances, conventional loans are less expensive than other government agency financing. So that's the first place where we start, okay? We also do FHA. So FHA loans will require as little as 3.5% down payment. They're a little more lenient on credit issues than conventional financing. They do have an upfront funding fee, and they have monthly PMI. So on conventional mortgage financing at 97, you know, anything above 80, you will pay, you know, mortgage insurance, and there's multiple insurance companies that offer that, and it's nothing you can really shop for. We do all that for you. But the FHA has their own PMI premium, and that stays on for the life of the loan. On conventional financing, you have the ability to either appraise out of your mortgage insurance, or you naturally will amortize out of your mortgage insurance. So as soon as you hit 80, you can petition it. Once you hit 78%, we have to remove it by law. But a lot of people now, in this rising rate, in this rising value market, are asking for appraisals to remove their PMI. They think their house is worth now enough so that their current balance is 78% or lower of the value of their current value. So they're getting out of PMI, which is really nice. FHA will stay on for the life of loan. You can't appraise out of that. They do offer rehabilitation loans for properties needing improvement, the 2 or 3K. Again, conventional mortgage financing has those as well. Freddie Mac and Fannie Mae do have those programs. If you're a veteran, I encourage you to always look at a VA loan. Okay, so if you're a current or former military member, that's the other area of 100% financing. Okay, they have a large upfront funding fee, but they don't have any monthly PMI at 100%. So VA loans are are a great way to go if you're a veteran. I always encourage you to start there. We always ask when we take an application or talk to a borrower if you are a veteran, because it's a great program. USDA, people think that's a stamp for meat. That's what I always thought it was, but they actually have a rural loan program. And again, this is 100% financing. They have lower PMI premium. It's only available in rural areas, and it does have income restrictions on their program. So you can only make a certain amount of money, income cap, in order to qualify. And I'll give you an idea of their territory. Like I'll take Dutchess County for example. In Dutchess County, basically, you have to be east of the Taconic, and it cuts off at like Hyde Park. So meaning, like, if you were in Rhinebeck, that's USDA territory or east of the Taconic. They generally carve out any urban areas. They want to keep it as a rural program. But USDA website does have a map. You can enter in a property address, and it'll actually show you if it's in a USDA approved area or not. It's pretty neat. Good program. I've used that plenty in the past, in my past originating history. And of course, we've talked about Sunny Mae, State of New York Mortgage Agency. 3% down. They've got the down payment assistance. They do have income restrictions, and they have different programs. So they have a low interest rate program, and then Achieving the Dream program. So depending upon your income level, you may be able to qualify for one of those, but we take you through the qualification of those. And again, they do have the Remodel New York, so it's a renovation program, and they do the NRP. So a lot of different options, a lot of different apples to bite into here to see which one might be the best for you. All right, so we're going to move on to the key players. Okay. So let's talk about the people that you're going to deal with. And before I get into this, I'm just going to tell you that when you're choosing someone, I really think it's important that you kind of trust your gut. If you like working with somebody, work with them. If it doesn't feel right, move on. There's plenty of people, and I could tell you in my career, I've had people that have come to me, and especially as a manager, saying, I really don't like, that Vince, he's a knucklehead. I don't know working with him. But and it's okay. Like, you want to work with someone you're comfortable with. It's a really big decision, and we would allow you to work with someone else. And I think that's the way you need to operate with your realtor, with your attorney, specifically, because you're going to be they're going to have some real intimate conversations with them about financial information, and it's a really big decision. So trust your gut and know. So a mortgage lender, I would love for you to all consider Rhinebeck Bank. It's financial institutions like us that issue these loans. Most of us all write to either Freddie Mac or Fannie Mae guidelines. Okay, so we're generally one or the other, or both of those shops, if you will. You're going to work with a loan officer. Okay, so it's a representative with a mortgage lender that can help you choose the best mortgage option for you based on your situation. They will have an NMLS number, a National Mortgage Licensing Number. If they don't, you shouldn't be working with you, and they shouldn't be having a conversation with you anyway. All right, and I want to say this: the Wild West is over. Back when I first started in this business, it was crazy. Things were mortgages are highly regulated now. As far as the banking world, I am probably one of the most regulated departments in the bank. So we have fair lending. We have to treat everyone the same, whether you're make $1 million a year or $40,000. It doesn't really matter. We're asking you for the same things. We can't give anybody a better deal. The rates are the same. Fees are the same. They're all dependent upon your credit. So we're really regulated. So your loan officer has very little, they're not selling you a car. They can't up price you, low price you, and make more money dependent upon the program. Our guys do not work that way. This industry has totally changed. I just want you to have a comfort level with that. And again, that goes into your gut. So, real estate agent, professional who acts as the intermediary between sellers and buyers. Okay. One thing I would caution you on, the listing realtor. So if you see a house that's listed and you're dealing with the listing realtor, they never truly represent you. A listing realtor's responsibility is to the seller. So if you want to work within the same office, that's fine, but you really need to have your own agent because it's hard to negotiate against yourself. Okay? So find someone as a buyer's agent that you want to work with that's out there finding homes for you and understands what you're looking for. And if you walk upon a listing and the listing agent is there, you may have a good feeling with them. Work with someone else in their office because they have a responsibility to represent the seller, and their fiduciary responsibility is not to you. Okay, so I just give you that little caution, if you will, that little piece of advice. A property inspector. So an individual is certified to conduct an examination of a home. So they're going to assess the condition of a property's foundation, the roof, septic, mechanical systems, heating, water, cooling, et cetera, and any safety issues, okay? And when if you find a property and you move to contract and you need to get a property inspector, ask about the fee, ask about the service, ask about the report, and ask a couple of them. So shop these around. It's okay. Part of these are you're going to get what you pay for. If somebody says, I'll do it and it's $200, I'm not looking to spend your money, but I would be very cautious on the type of report you're going to get for $200. So buying a home is going to, there's going to be some cost up front in doing some of these things. And one of them is a property inspector. But you want to know everything that's going on with that house. And here's one thing I will tell you. Do not expect your inspection report to come back and he's going to say, wow, or she's going to say, wow, this thing is fantastic. No problems. That's the last thing you want. I've been in my house now since 2005, and there's still things that I remember from the property inspector's report that I would have never, ever considered or looked at. There was little holes in my siding that the inspector said, listen, you need to take some of that little foam and plug these up so little bugs can't get in. I mean, I could have walked around the house 1,000 times and I would have never seen those little holes or thought to address them. So you want that inspector to tell you everything that needs to be done. And they'll give you a list, basically color-coded. Red is an emergency. It's got to be done. Yellow, green, and it'll be all of these different items. And it really gives you a firm understanding of where you're moving into and the things that you should be concerned about now, not now, or maybe 5-10 years from now. Okay? A real estate attorney. So it's going to represent the borrower, the seller, or the lending institution in its transactions. So not all attorneys specialize in real estate, okay? And remember, they work for you. Your attorney works for you. Ask them what they charge, shop around, and trust your gut. You can use the same attorney who will close for the bank. You can't use the seller can't use the attorney that's closing for the bank. So, if you're working with a bank and you know who the bank's attorney is going to be in that transaction, chances are they do a lot of real estate. You could always ask about using them. And we all lenders have recommendations of plenty of bank attorneys. And one thing I will tell you is that I've done loans for plenty of attorneys before, and I've asked many of them, are you going to handle your own transaction? And most of them don't do real estate, and they've told me there's no chance I'm not handling my own transaction. I haven't looked at real estate law since I was in law school, so I'm going to use an attorney in my firm who does only real estate. So, and because my name is Vincent, if somebody's going to use their cousin Vinny, and they're not in real estate, be very wary of it, because if someone's a trial attorney and they have trial that day, they're not worried about your closing. So that's why you want to specialize with someone who really works in real estate and has a firm knowledge of the area as well. So an appraiser, licensed individual who's going to provide an estimate of fair market value of the property being purchased. Okay, appraisers, just so you know, appraisers work like they're driving a car, okay? They look in the rear view mirror, not out the windshield. So the value is, they're going to base the value on similar homes, comparable sales that have most recently closed, not what's on the market and it's going to close. So they're not looking to blow up the number and make it higher. They're there to justify the sale price based on the most recent comparable sales, okay? And you got a closing or a settlement agent, and the party who conducts the purchase closing. It can be either a title company or real estate attorney. Some states allow the realtor and the title person to conduct the closing. We're an attorney state. You're going to have the lender's going to have an attorney who's going to handle that with the title agency there closing that loan. And then your mortgage insurer. So, PMI companies, they're the people that offer mortgage, to insure mortgage loans where the borrower puts down less than 20%. Most of them also offer home buyer education and mortgage training. They're very good about their training that they give on home buyer education. So a lot of them have it online. But I would start, number one, with LaShonda for home buyer training. Don't forget about LaShonda. We got to get her involved here with that home buyer training. So she's ready. Okay. So that's the key players. Let's look at some steps in choosing your home. Let's just talk about this real quick. So the key thing is knowing the difference between what you can afford and what you want to afford. Because you might be able to afford exactly what you want. You might be able to afford a lot more than what you want. Hopefully that's the case. But knowing those two numbers is very important, and that's what you're going to work with your loan officer on, okay? It's because it's really this is one of the biggest financial decisions for most people. I mean, besides starting a 401k or retirement. I can tell you the first house my wife and I bought, we had to kind of snap our realtor back in line. We were looking, and this is back in 1993. I'm dating myself a little bit here, so, or maybe even earlier than that. But we were looking in the 150 range, and we had a realtor who was showing us $300,000 houses. And she's like, "Yeah, but I think you can afford that." I'm like, "Yeah, but I don't want to afford that." So know your numbers and know what you want. Try to keep emotion out of the process. Okay. Be wary of love at first sight, and you have to be willing to walk away. I could tell you, more times than not, we will talk to first-time home buyers on a Thursday or Friday who say, "Yeah, we're thinking about looking for some houses this weekend," and we do a quick pre-approval and go over some numbers. And guaranteed Monday morning we get the call, "Oh my God, we fell in love with." It happens all the time, and not that they don't move on and or continue and buy that house. But most times it's love at first sight, and then they start thinking about it and considering some other things and doing some research, and we many times move on into something else. But you have to be willing to walk away. Okay, so keep the emotion out of it. Conducting thorough research. Here's what I would tell you: if you've kind of narrowed in on a house, see it at different times during the day. I'd see what it's like at night. I'd see what it's like during the morning. I'd figure out, traffic, noise at night. I could tell you when my wife and I first got married, we rented a house in Kingston in the city. And I could tell you that I used to be able to read a book in the middle of the night with the lights off because of all the street lights. And it was really, really bright. And we bought our first house over in Ulster County. And the first night we stayed there, I shut off the lights in the bedroom, and I thought, "Oh, my eyes will adjust." And they never adjusted for 10 years after that. It was so dark. It was just an amazing difference. And it's just a story to say, check out the surroundings of the house, okay? Because it's not just about that. And it is, moving on, it's not just about the house, okay? You may love the house, you may hate the neighborhood. You may love the neighborhood, you may hate the house, okay? It's about all the things going around. How far are you from a school? Next thing, planning ahead. And you're doing that right now, planning ahead, which is great. How long do you plan to be there? I thought for sure the first house we bought in Ulster County, I told my wife 3 to 5 years max. That's it. Then we're out. We'll move. We were there for 10 years. So you may have a plan, but Does something get in the way of your plan? Do you start to have a family? Do you need more room? You know, consider that resale value. So there's a lot of things to think about when you're weighing out your decision. And then, of course, I can't stress this enough with LaShonda, homebuyer counseling. Talk to professionals. Fully prepare yourself for what's involved. You know, I've got some things going on in my house right now I don't want to talk about with a buried oil tank and the things I'm trying to remove. So I'm staring at a huge bill. So I can tell you from experience, there's things that come up that you just, you know, you may have planned on, you may have thought about, but there's always things that pop up you have to be prepared for. So just doing thorough research, talking to a counselor, understanding the ins and outs of buying, and I think you're going to make some great decisions. Okay, so I think the next slide is some resources. Yep. So you know how to get a hold of Hudson River Housing. You have LaShonda's name, her information. You can obtain a free credit report. Remember, annualcreditreport.com. That's a free credit report. One thing I will tell you about your credit report, when you get your numbers, there's about 20, I think there's over 20 different credit score scenarios, models, if you will. Meaning if you're going to buy a car, you know, lenders will pull a credit report that really is more geared towards a car purchase. You know, that report really wants to show how you've made your car payments. It's going to be a different number than what you get when you're looking for a mortgage. It's a different model. So your annual credit report, you want to see if there's anything on there that you don't know about. Are all the liabilities correct? Is there any derogatory information on there that's taking you by surprise? So you want to get a report at least once a year on there. And then there's, you know, the CFPB, the Consumer Financial Protection Bureau. They have a know before you owe, a great toolkit that explains a lot about the mortgage process, all the ins and outs of it. You know, Consumer FTC, and then Fair Isaac, as my FICO talks more about credit. So a lot of different resources that you can peruse at your convenience to get more information, or reach out to us. We're always happy to help. I think you can tell by you know, we've taken up wow, almost an hour and a half, Melissa. We did good. And with that, I'll open it up for any other questions. What do you got in the queue? Happy to chat.
Great, thank you so much. Like I said, that was so enlightening, and we do have another few questions, and then I'm also going to see if anyone wants to ask any in the chat box in our last few minutes, or mute themselves and ask. Before I do that, I'm just going to ask you the last one. From the appraisal, can you put pressure on the sellers to make home renovations before closing?
That not necessarily from the appraisal. That's going to come from your inspection. Because your appraiser is really worried, is really going to be concerned more with value. They're going to do the cursory look around the house. They're not going to, an appraiser's not an inspector, so they're going to look for items. For instance, if they're doing an FHA appraisal and you have steps that have no railing, they're going to require, you know, that a railing be put up. So an appraisal can come back with items that need to be addressed. So appraisal could come back not as is, but as to, you know, to be completed. But a lot of that is mainly going to come up in your inspection of items that you're going to negotiate. So the answer is yes. The appraiser may come up with some things, but it's more likely that they'll come up during the inspection phase, and you'll negotiate more in that section of the process than the appraised process. Okay.
Great, and I'm just scrolling to see if I missed any, but in the meantime, if anyone wants to unmute themselves and ask, please go ahead, or put it in the chat box. Just the last couple of minutes. Gabriella?
Yeah, I have a question for you, Mr. Vince. Thank you so much. You have given me so much information because I'm in process of wanting to buy a house, but I have so many questions. So you just kind of enlightened me. I'm so excited. Anyway, so my question for you, what do you think of foreclosures? What is your opinion on that?
I'm all for them. I mean, we need to get the foreclosures out of foreclosure and and we need to get a borrower and a homeowner in them. So the trick with foreclosure is, what kind of condition is it in? Does it need repair? And how do we address that? So, yeah, I mean, foreclosures are viable options for first-time home buyers. We see, we see a decent amount of them. Again, it's like, whether it's a foreclosure or whether it's a general resale, it's really the condition of the house and the affordability and how you set up your financing. Yeah, but we work with these quite often. The one thing about foreclosures I will caution you about is in your closing costs, many times the lender that has the foreclosure in the contract is going to make you pay the transfer tax. So it's one little nugget that your lender's got to watch out for, because you'll pay mortgage tax and you will pay the transfer tax. Not an astronomical amount, but every little dollar we can give you a heads up on to save, we want to make sure we let you know.
Thanks. And there was also a question about, does it make sense to close your credit card accounts or pay them off before you start the process?
Great question. Here's one thing you want to consider. We often tell you, do not close them. You can pay them down as long as you don't need those assets to close. But closing an account actually can hurt you, because let's just say you have an old account that you've had open for 10 years and you close it. You literally have just lost that history of your credit. So we often talk to borrowers about, and when you look at your credit report, as long as it's not costing you money to keep it open, don't make any drastic decisions before you're looking to buy a house with your credit. Basically, assets or credit. You don't want to move money around, because we have to source funds. Chain of custody of funds is very important with assets. So you don't want to move money around between accounts, and you don't want to make drastic decisions with your credit and closing out accounts, paying things down. I mean, I've seen instances where people have closed out accounts, it's hurt their credit, and where they paid off accounts and they needed the assets to close. So that's part of the conversation of how you're setting up your financing, what assets you need to close, what you may need in reserves. And we also have had people who have decided to pay down their debt because it's helped them qualify, because it's lowered their monthly debt to income, because they've removed that monthly liability and they've had the assets to do it. So it's all strategies, and it all depends on someone's specific, situation and scenario. But yeah, all of these apply. It just depends on your certain scenario.
Great, thank you. Well, we have like 2 more minutes. Anyone else like to unmute themselves and ask a question or put a last one in the chat box? I think I got them all, and if I didn't, I apologize, and feel free to ask away now.
And here's what I'll offer up to you all, because what's going to happen is you're going to get off this call, and a half an hour from now, you're going to think, oh, man, I should have asked that. Email us. Feel free, please. Don't think that it's over. Email away. Gabrielle, you got your hand up. Go ahead.
Yeah. Can you share with us, or you, Melissa, can you guys share a website where we can kind of search a more like reliable website to search about houses, what the prices are, like go to the taxes, like figure out the taxes, the school district, etc. Is any website that you recommend that would be more like trusted?
That's a good question. There really isn't one specific site to go to for all of that. I would encourage you. Here's what I would encourage you to do: is meet with a loan officer to figure out what you can afford, because you don't want to go to a realtor website and start looking at properties unless you know that you have that comfort level. It's in your ballpark, because otherwise it's really all conjecture until you know exactly what you can do. Do that, because even when you start working with a realtor most likely is going to ask you hey, have you spoken to a lender? Are you pre-approved? Because otherwise, they're not going to really look to show you houses unless they know that you're a serious buyer and you're in that market to afford that price. They like to affectionately call that wheel estate, not real estate. They don't want to be driving around unless they know that somebody is approved, for those loan amounts. So I would really encourage you there, because that's really the basis. Talk to a loan officer, review your credit so you know exactly what you're dealing with, and then hey, if I have to, work on some of these credit cards, or I can increase my my buying power, then I can look for different types of houses, or more expensive or less expensive, or I can look for some low cost foreclosures, knowing that I have to put X amount of dollars into them, and I can work that into a loan. Does that make sense?
Yes, wonderful. Is there one last question from anybody? We did the courtesy of putting your contact information in the chat box as well, and we'll certainly send a follow-up email to all the attendees.
Perfect.
Vince, this is Jeannie. This was terrific. And like I said from the beginning, I wish I had this before I bought a house. So informative. And thank you very, very much. And, LaShonda has put it out there to offer assistance. So take her up on that as well. Thank you, LaShonda.
You're welcome.
Well, thanks so much. This is really, I got to tell you, this is the real fun part about my job. I have a job where people don't normally come to me. They normally come to me when things are broken. So I like starting this out fresh and teaching and getting you the information you need, because it really is a joy when we're at the closing table and we know that we've helped somebody improve their family life and start out on a lifetime of building equity and having a happy home. So it really is important to us. We really get a kick out of it. That's, we all make a living doing it, but this is really the fun part, is teaching somebody how to buy a house and then watching that evolve in front of us. So I wish you all the best of luck. Please reach out to us if we can help. More than happy to do it.
Thanks. And I think, Johnson, did you have a question?
Yeah, I have a question. What is the rule of thumb to quickly determine what amount of the price of a house that you could purchase?
All right, quick rule of thumb. Here's what I would do. I would take your total monthly income, multiply that by 0.4, and then subtract out what you think and a little bit of what you think your monthly taxes and insurance would be. And then you could look online at an amortization. You could probably pull up, Google amortization table. And honestly, you could just fool around and say, okay, hey, at $200,000 at 3.5%, what's my monthly principal and interest? And you can get close to that number. That'll give you a range. That'll give you a range of what you think you can get in. Now, again, depending on what your other debt is, that may blow your back end out, from above 50%. I don't know about your other debts. But just on a front end basis at 40%, that's kind of a rule of thumb. Hey, I'm comfortable in there. You're hoping that your other debt that you have is not more than 5 to 7% of your gross income. Does that help a little bit, Johnson?
Yeah, that does help. The other question would be, if you're debt free, other than just your monthly rolling debt, other than that,
Sure.
you're debt free. What does the picture look like?
You can go higher, but the other thing is that, and I've seen people get approved at a 45 front end and a 45 back end. It's tricky, because depending upon your credit, if you have real good credit, probably would work. If your credit is not sterling, and again, it's hard because these are system driven. It's a computer models that give us the feedback on the results. So the computer model may say, hey, wait a minute, we don't like the fact that they're 45% front end, because once they move into a house, they're probably going to have other expenses. So then you don't have much room on the back end.
So, okay, so go ahead.
The roundabout answer to that is you can go higher. You can look to go 42, 43%, maybe even 45. But really, I would just be a little cautious about overreaching on that.
Okay.
And again,
good.
on pre-approvals, just so you know, John, we can run pre-approvals through our system and get an online approval, so that we know that as long as you fit into that, into that scenario, that you're going to get approved. Make sense?
Okay. Yes. What is excellent credit in your determination?
That's a very good question. There's always a sliding scale. When I first got into business, excellent credit was, above 700. Then excellent credit was, above 7 or 680. I look at excellent credit. Personally, I would define that term as where do you get your lowest loan level pricing adjustments from the agencies, meaning where do they give you the lowest fees for credit, and it's generally above 720.
720. Okay.
Yeah.
Thanks so much. So Vince, that was incredible. Really appreciate all of that. LaShonda, thank you for all the resources that you offer. I'm going to turn it back to Yadira for closing.
All right, thank you, Melissa. United Way would like to thank all participants in participating in today's workshop. Hopefully, we have expanded your knowledge and better equipped you with household decision-making. We would like to thank Rhinebeck Bank for sponsoring today's workshop. Special thanks go to Vince, as well as LaShonda, and also members of our team, Jeannie for the warm welcome, Melissa for monitoring the chat box, Peter and Chrissy for putting up upcoming events in the chat box, and Emily for technical support. Please be on the lookout for our first time homebuyer survey. Let us know how we did. Everyone, have a great and productive day, and we will see you next time. Bye.
Thanks, Yaya.
Thank you. Thank you all. Have a good day.
Thank you, everyone. Great job.
Thank you. Thanks for coming.
Great presentation.
Thanks,
so
Johnson.
much.
Good to see you.
Good to see you all. Back to work.
Thanks, you guys, for having me.
Thanks
It's
so much.
really appreciated. And I'll be in touch because we have some things coming up in 2021. Trying to get things back into normal gear. So I'll be in touch with you to let you know what's going on, because we'd like to involve the United Way with some things. So I will be in touch, definitely.
Fantastic. Thank you so
Okay.
much for all you do.
Thank you so much.
All right, you're welcome.
Looking forward.
Stay safe.
You too.
Thanks. Okay, just us.
Good job.
Great job, Yaya.
Excellent. Yeah. Let me tell you, I'm so crazy busy, and this is a crazy day. And I was just going to do the welcome and sign off. And I was like, let me see what this is about. It was so informative. It was a great pace and everything, the information. Somebody had said, sit here. I have my iPad, so I kept doing emails and stuff. But totally engaged and everything. I think it was excellent, and I was sincere. I wish I had that before I bought my house.
Me too.
It's kind of like impulsive. Let's just buy a house. Let's not look at anything. And I've been in the same house for 26 years, so it has worked, but there was lots of things that went into it. But excellent job.
Yeah, this is incredible. Really great job. I know we had 42 in our Zoom room, and then we had another 13 on Facebook that were watching. So we had 55.
Awesome.
Awesome.
I know. Wasn't the goal like 30 or something like that?
Yeah, our contract is 25. So whenever.
It's a beautiful thing. It's a beautiful thing.
Yeah.
All right, I am going to say goodbye now because I've got to plug in
Yeah.
and finish, and everyone's asking me for stuff. You
Of course. Thanks for everything, Jeannie. Thanks for
Thank
staying
you.
on.
Absolutely. But great job in the chat room and everything. And I think Emily's here. I'll tell her she did a great job with that. All right.
Very good. Thanks so much. Christy and Peter, thanks so much for all of the help that you did too with the questions. Really appreciate that. I know I kind of put you on the spot. I wasn't realizing that I was going to have to screen share because originally Vince said he would. So then I was like, oh, okay. And then I'm like, oh shoot, I can't like see any of the questions. Like, so everything worked out. So thanks for everyone for being on the text thread and just like communicating. That was great too, Christy, how you were typing out the questions. It made it much easier than trying to like.
Yeah, no problem. Anytime.
Yeah. Do you feel good?
I'm glad we put this to bed.
Yeah.
You did a good job, Yaya.
Yeah.
Oh, thank you. Appreciate it.
All the remarks were really well written.
Tired.
Yeah.
I like worked last night, so like that little nap for 15 minutes and then like doing the presentation. I'm just so glad I was like coherent.
Yeah, no, you were great. And, all of the remarks you wrote up, everything flowed well. Everything went well technically. We had a great turnout, lots of questions, which is what makes it like, know that it really had impact. There were so many questions. Oh, can somebody download the chat box before I end this meeting?
I don't know if I can do
Can you
that.
copy paste it into a Word document?
I got it.
Okay, that would be great. That's one thing I always like nearly forget. So
Give me 1 second. Copy and paste it. Great job, guys.
Good
yeah,
job.
that was awesome. So you've had 2 successful workshops already. That's great.
Yes, I'm very happy.
Yeah. Vince is great too. He had such great information.
Yes, he is.
Yeah. He is very personable.
Yeah. Emily Darrow was like, why isn't his video on? I was like, he doesn't want it on. What am I going to do?
I got it copy and pasted.
Okay, perfect. Good. All right. And just before, because I know I'm going into meetings and stuff, Peter, I know we're meeting later to do more reporting. Christy, thanks for your help so far with copy editing.
Yeah, I'm looking into it today too. So.
Hi, Emily.